We get many calls from people who see the current situation in the Dominican Republic as similar to the Toronto market between 2014 and 2019, when simple speculation brought in excellent returns. Many people made fortunes back then, but comparing that period in Toronto to the current situation in the Dominican Republic is completely incorrect. In the Dominican Republic, things are different. Let's take a look at how things really stand. And let's start with who is buying real estate in the Dominican Republic. About 25% are retirees. These are people who buy property primarily for their own personal use, and they typically plan to spend about 5 or 6 months of the year living there during the winter season. The second category of buyers consists of pure investors. These are the ones who want to earn an income. Usually these people aren't very interested in visiting. They might go there a couple of times a year for a week. But the most important thing is the rental income, because in the Dominican Republic, the yield is very high. That is, the yield now is at the level of, let's say, from 8% in the most budget complexes, reaching up to 15% in the best ones. So on average, the payback period is faster than 10 years. Compared to Toronto, for example, it's 35 to 40 years. The third category, probably the largest, accounts for about 50% of our buyers. These are individuals who are actively purchasing real estate as a long-term investment for the future. Essentially, we are talking about people who are roughly 40 to 50 years old, who are currently working full-time or managing their own business and are consequently quite busy. So they typically plan to visit the property with their family in the coming years, perhaps just a couple of times a year for 2 or at most 3 weeks at a time. For the rest of the year, this property is simply rented out to others. Over, say, 10 years, even if it was bought on credit, meaning you took a full 100% loan, for example, against a house or apartment in America or Canada, it has paid for itself in that time. Over time, it becomes a fully paid-off asset that generates a good income. Besides that, retirement approaches, and perhaps by then you'll want to spend longer periods of time there. Plus, it's certainly a great asset in terms of appreciation. Prices in the Dominican Republic are rising fast, and over time, this real estate will represent significant capital. How the Dominican Republic differs greatly from Toronto in 2014 to 2020, when people made a lot of money. The thing is, the sales conditions in the Dominican Republic are completely different. It's not like Toronto, where you put down a 20% down payment and then waited for the property to be built. It takes a long time to build, 4 or 5 years, and then you resold that property at a much higher price. And that small 20% you put down during the construction period, the property's value increased by 20 to 30%. And it turned out that this small deposit you put down was actually working at a very impressive interest rate. People built massive fortunes on this, and many individuals created a really large amount of capital specifically through the power of speculation. But that is the speculative segment. In the Dominican Republic, it barely exists. Why is that the case? Well, the standard deposit structure for buying real estate in the Dominican Republic is quite straightforward. When you sign the contract, you pay 20% upfront, and then during construction, you gradually pay another 40% in small installments, which essentially functions like an interest-free developer loan. So by the time the construction is finally finished, you've already paid 60% of the property value. Then, upon receiving the keys and the title, you pay the remaining 40% and get the property completely debt-free. It's not always out-of-pocket money. It could be a line of credit taken against your own property in Canada or the US. And as I mentioned, in about 8 to 10 years, you'll pay off this loan, right? And then after that, you'll own the property completely without any debt at all. So in the Dominican Republic, there's practically no speculative element. Meaning there aren't people who buy at the pre-construction stage and sell immediately after construction's finished. Yes, it appreciates, but the situation in the Dominican Republic is different. For instance, if you buy something new from a builder in Canada, it's always more expensive than the resale market. In the Dominican Republic, it's the complete opposite. A new build at the foundation stage is always about 15 to 20% cheaper than it would be at the project's final completion. But if you consider that you've already put in 60% during the construction phase and the property value rose by 20 minus a 5% real estate fee on the sale, it turns out that the invested money didn't really work at a high interest rate. So in the end, there's no real speculation as such to speak of. You can't enter here with $50,000 like in Toronto. There were times in Calgary when real estate was cheap, costing $200,000 to $300,000, and many developers even offered purchases with just 5% down. So to buy a property, you only needed $15,000 to $20,000, and you bought an asset worth $250,000 or $300,000. Again, there were times in Calgary when everything appreciated very quickly and great money was made because you put down $15,000 to $20,000 and ended up reselling it after construction for $70,000 or $80,000 more than you bought it for. And those $15,000 invested worked at a wonderful interest rate. Not in the Dominican Republic. And in the Dominican Republic, it's impossible to enter with $50,000. For example, in the luxury segment, if you buy a two-bedroom apartment, the price in an average area would be around $200,000. So you only have to pay $40,000 on the contract, and then another. You will need to pay $80,000 throughout the construction phase, spread out over a period of 2 to 2.5 years, with installments typically due every 3 months. The Dominican Republic remains an excellent choice for those who already have established roots here and are looking to invest their capital wisely to help grow their money over time. For example, there's a strategy that retirees use very often. They take out a line of credit against existing real estate and use that line of credit to buy an apartment in the Dominican Republic. In 10 years of renting, it has completely paid for itself. You finally paid back the line of credit and created a free place in the sun. It's your own property in the Dominican Republic, a perfect sanctuary where you can come to relax, unwind, and invite all your relatives to visit. And it's your asset, yes, so you've simply multiplied your money. So investments in the Dominican Republic are essentially completely different from what we are used to in North America. It all works perfectly, you just have to do it wisely and, most importantly, on time. See you.